So listen, I know that sometimes the world can seem topsy-turvy and out of control. And that is why we need accounting, because accounting is always in control. Accountants are always in control, at least of their accounting system. So in a time of trouble and strife, I always like to come back to a really important accounting concept, and that is normal balances. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm. That's my sidekick, Terrence. Your joke's getting a little old, Terrence. Maybe you want to freshen it up a little bit, okay, buddy? Great, thanks. So, in talking about normal balances, which are one of those key points of accounting that we all need to understand in order to either do well in accounting class or to practice accounting in the real world, whether as a business owner or bookkeeper or accountant, we need to come back to our accounting equation because that is the base of everything. And the accounting equation is assets equal liabilities plus equity. That is the basis of everything that we do in accounting. So to get more in depth on the accounting equation, you can check out the accounting equation demystified video, which I'll link in the description. But as a refresher, assets are things that a business owns. Liabilities and equity are what a business owes. So liabilities are owed to a third party like a bank or a credit card or a vendor. Equity is owed to the business owners or the stockholders, right? Because they have invested money into this business and we owe them that money. Now, I want to talk specifically about this owner's equity part of this because this is the key to understanding normal balances. Owner's equity is made up of the owner putting money into the business, whether as a sole proprietor or as a stockholder where you're buying stock in a business. So you're giving the business money. So that is an owner investment. Now, if you as an owner take money out of the business in the form of an owner's withdrawal or dividends, then that is going to reduce your owner's equity. Okay, so owner's investments minus owner's withdrawals or dividends is one portion of our owner's equity picture. Now, the other side of that is that we are not in the business of not making money, right? We want to actually make profits in this business. And when we have a profit in a business, it increases the owner's equity, right? Part of that money belongs to the owner. So those profits and losses are going to increase or decrease owner's equity. So profits increase owner's equity and losses decrease owner's equity. And we have an account where we keep track of all of those profits and losses, and we call that account retained earnings. So now we have, as part of our owner's equity, we've got owner's investments, less owner's withdrawals, and then we're going to add or subtract profits and losses. So if we look at owner's equity as those two different pieces, we've got owner's investments minus their withdrawals or dividends. So you can consider that to be the owner's net investment. They put in $10,000, they took out $2,000, their net investment is $8,000. And then on the other side of that, we said that profits and losses increase or decrease the owner's equity. And how do we come up with profits and losses? We're going to take our revenue minus our expenses. So if revenue is $10,000 and expenses is $5,000, we have a profit of $5,000, which increases our owner's equity. If our expenses are higher than our revenue, then we have a loss and we are decreasing our owner's equity. So then we can look at this accounting equation on the owner's equity piece of it. We can add on to it. So we've got owner's investments minus withdrawals or dividends plus revenue minus expenses. It's still our old friend, the accounting equation. We're just kind of spelling out the details a little bit more. So here's what that looks like. We've got assets equal liabilities plus owner's equity. If we expand that out, we now have assets equal liabilities plus owner's investment minus dividends plus revenue minus expenses. And this is the part where your mind is maybe going to be blown, because it was that for me, okay? And to be honest, I was like today years old when I figured this out. You ready for this? When we're talking about normal balances, here's the way that's going to work. So over here on the left-hand side, we have our assets. And then if we jump over to the right-hand side of the equation, we have two items that decrease owner's equity. We have dividends and we have expenses. So we said that owner's investments and revenue increase owner's equity, and dividends and expenses decrease owner's equity. So when we're talking about normal balances, assets, dividends, and expenses work the same. Liabilities, revenue, and equity work the same. So when we group those together, we end up with something called normal debit balances and normal credit balances. And as a reminder, all debit means is the left-hand side of the account, and credit means the right-hand side of the account. Debit's on the left, credit's on the right. So normal balances for assets, dividends, and expenses are debit balances. Normal balances for liabilities, revenue, and equity are credit balances. Now stick with me, because I'm going to show you an easy way to remember this. And I'm also going to give you in the description a link where you can download a handy little cheat sheet so you can remember this. So here we go. We have our normal balances for assets, expenses, dividends. Our normal balances are a debit. For liabilities, revenue, equity, our normal balance is a credit. So what that means is if we want to increase an asset account, we're going to debit it. If we want to decrease an asset account, we're going to credit it. The same thing with the expenses and dividends. If we want to increase those accounts, we're going to debit them. If we want to decrease, we're going to credit them. And then liabilities, revenue, and equity, if we want to increase those accounts, we're going to credit them. If we want to decrease them, we're going to debit them. I said I'd provide you with an easy way to remember this. Here's what I want you to remember. After eating dinner, let's read ebooks. Accounts with debit balances after eating dinner, assets, expenses, dividends. Let's read ebooks, liabilities, revenue, equity. So after eating dinner, have normal debit balances. Let's read ebooks, have normal credit balances. So now that we have that little bit of information, we're going to actually take that and we're going to apply it. Are you ready for this? We're going to do some actual journal entries to see how this works out. Your very first journal entries with me. So here we go. Here are 3 sample journal entries. And you'll see the D and the C, that's your debit and your credit. Debit is left, credit is right. So in the first journal entry, you sell to a customer and they pay you in cash. So what do we have going on here? We have revenue. We sold to our customer and we are getting cash for that. They're paying us right now. So we are going to increase our cash account. Cash is an asset. An asset has a normal debit balance after eating dinner. And so we want to increase that account. We're going to debit it by $100. Revenue has a normal credit balance. Let's read ebooks. So revenue, we increase on the credit side. So what we've done here is we have increased our cash account and we have increased our revenue account. Stay with me. We have more to come. So now let's say we pay our electric bill. It's $50. So we have an expense called utilities expense and we're paying cash. So what's going on here? We have an expense account. We want to increase that expense account. Expenses have a debit balance. So we increase them on the debit side, and we are reducing our cash because we're paying our bills. So when you want to reduce an account that has a normal debit balance, you credit it. So we are increasing our expenses by $50 by debiting it, and we are decreasing our cash by $50 with a credit. Now let's say our business owner wants to take some money out of the business. So we said that an owner's withdrawal or dividend is going to be a debit balance normally. So we're going to increase that on the debit side. And we are taking cash out of the business. Cash is an asset. When we want to reduce it, we're going to credit it. So we're going to do a journal entry that says debit owner's draw $5 and credit cash by $5. Now, once you do all of these journal entries over a month, those entries get posted to accounts where we add everything up, and then we use that information to create our financial reports. So the rules of debit and credit all come back to this concept of tracking things within the accounting equation. And then we've got accounts that have normal debit balances, assets, dividends, expenses. And we've got accounts that have normal credit balances, liabilities, revenue, equity. And the way that we increase and decrease those is based on those normal balances. So you increase a normal debit balance by debiting it, and you increase a normal credit balance by crediting it. Now, if you pair this video with the debit and credit video and the accounting equation video, and then you add in the journal entry video, you're going to have a really good foundation in accounting. So there you have it, an explanation of normal balances. And the only time I really recommend being normal is with normal balances in accounting. The rest of the time it's overrated. So until next time, stay in balance, my friends.